Friends, today we will discuss Unit 14 of International Financial Management. It is related to international portfolio investment and international asset pricing. So, before discussing this chapter, let me first tell you what are the learning objective of my class today. After going through this particular class, you can acquaint yourself with the utility of investing across the globe. What are the benefits of international investments? You can know international portfolio investment, and you can know how foreign investment risk can be reduced through investment in different instruments outside the country, and you can identify different barriers to international diversification, and you can know how efficiently an internationally diversified investment portfolio can be improved through hedging strategy. So we can know different hedging strategy with the help of international portfolio investment. First, let me tell what will be the structure of my discussion today. First, I will give an introduction to the chapter. Then we will discuss international portfolio investment, what are the benefits and the risk associated with it. Then we will discuss international bond investing. Next, we will discuss international equity investment. Next, we will discuss how to measure exchange rate risk on foreign security. Next, we will discuss international portfolio diversification. We will discuss the concept called home bias, and we summarize our discussion, some self-assessment question, and further reading materials. This will be the structure of my discussion today. Friends, with the help of integration of global financial market, the integration of global financial market has taken place throughout the world due to development in ICT, international or information and communication technology. With the development of information and communication technology, it enabled transfer of information across large geographical areas. Through different countries, we can communicate within fraction of seconds, and all the markets of the world have been integrated, has become one. The integration has been immersed due to new opportunities for both retail and institutional investors. This led to integration of global financial market, and it has now become easier to acquire information about the foreign listed companies and invest in foreign companies and put them in a part of your portfolio. So the international securities investment or portfolio investment have emerged due to emergence of new information and technology. International portfolio. So what is international portfolio investment? It's the investment in capital in foreign financial instrument with the objective to minimize risk through diversification beyond national boundaries of a country. So if you invest in a foreign country's securities in order to minimize your risk, that is known as international portfolio investment. The intention of the portfolio investor is to make short-term gain and to minimize the risk through international diversification. Now we will discuss what are the benefits and risk associated with international portfolio investment. Friends, following are important risk associated with international portfolio investment. We know that international investments have certain inbuilt risk associated to it. The risk may arise due to taxation, it may arise due to exchange rate fluctuation, it may arise due to foreign regulatory framework and other macroeconomic variables. So first we will understand different risks of international portfolio investment. Then we will discuss what are the benefits you get through international portfolio investment. When you invest in foreign companies share, the following risks are inherent. That means global portfolio management has its own risk or drawback. First drawback arises due to tax rates. What is tax rate? That you know that the foreign income is taxed at a higher rate in many countries. Okay, so whenever you consider investing in a foreign market, you have to consider the post-tax return on international securities. If the post-tax return on international securities is greater than domestic return, then only domestic post-tax return, then only you can consider the foreign investment to be profitable. So tax rate affect the international portfolio investment. Second one is unfavorable exchange rate movement. Whenever you invest in an international company, you receive some dividend or interest out of this, and these dividend and interest are subject to currency risk or exchange rate risk, and the value of the investment also depend upon the currency risk or exchange rate risk. The value of such security diminishes if the currency in which if you invest the money weakens. That means if a company, suppose a Indian person invest in US company share, and if US dollar weakens, then the value of his investment is also comes down. This is known as exchange rate risk with forex investment or foreign security investment. Next one is next limitation is frictions in international financial market. We know that there are many frictions, many restrictions, many hurdles imposed by government, and these government regulations may relate to tax regulations, implicit and explicit transaction expenses, and these put a restriction on international portfolio investments. There can be various type of control tools which are imposed on the foreign returns and foreign outflow of funds and taxes on international FPI investments, and this put a restriction on international investment. Next, manipulation of securities. Or we know that in developing countries, the securities prices are normally being manipulated by big brokers. They can be manipulated by the government. Government can manipulate the price through its policies, through monetary policy, through fiscal policy. Similarly, big brokers can manipulate the security price. So this is one important limitation of foreign investment. Next one is unequal access to information. When information access is not equal for all investor, domestic as well as foreign investor, foreign investment has certain limitation. So if there is wide gulf across cultures, it could hurdle global portfolio management or portfolio investments. So these are certain hurdles of international investment. But what are the benefits you get through international investment? Why people are interested in investing internationally? We know that each and every investment has two type of risk. What are the two type of risk? We know that risk in a portfolio can be divided into two parts. One is known as unsystematic risk, another is known as systematic risk. Unsystematic and systematic risk. Unsystematic risk are unique risk or company specific risk. Unique risk or company specific risk. But systematic risk, so these unsystematic risk affect a particular company or a group of company. Systematic risk is a country specific risk. It affects almost all the companies in a particular country. it is a country risk, or it is known as market risk. We know that the own systematic risk can be reduced through diversification. If you diversify through domestic diversification, that means if you invest in many companies of a particular country of different sectors, the own systematic risk can be minimized. But through domestic diversification, you cannot reduce systematic risk. But systematic risk can be reduced through international diversification. That means if you take exposure in different countries' market, you can insulate yourself from market risk of a particular country. Hence, the political risk or country specific risk can be reduced through international investment, political risk or country risk. Hence, to get the benefit of diversifiable risk, you can go for international investment. So international investment is generally required to reduce systematic risk associated with a country. It is used for reducing the political risk or macroeconomic risk of a particular country. So people therefore prefer to go for international investment or international portfolio investment or foreign portfolio investment. The foreign portfolio investment may be in two ways. One is foreign credit bond investment, another is foreign equity investment. So FPI may be of two types. First one is foreign bond investment. Second may be foreign equity investment. First we will discuss international bond investment. Next we will discuss international equity investment. So first our discussion will be international bond investment. What is bond? Bond is a creditorship securities. When you invest in a bond, you give loan to a particular country. The loan capital of a company is divided into smaller and smaller part, and each short part is known as debenture or bond. The bondholders are the creditors of the company. The bondholders provide long-term creditorship fund to a particular company. Normally, institutions are interested in investing bond. Institutions means commercial banks, mutual funds, insurance companies, pension funds of a country are normally go for global bond investment. Okay, so global bonds play a major role in case of international bond investment. Okay, so these factors influence to purchase and issue bonds or global bonds. Okay, first, what are the factors why companies are interested to issue global bonds? First, issuing bonds in global market, foreign nation improve the image of the company. Second, if a MNC issue global bond, it improves its image. Then MNC want to raise money in countries where currency is widely accepted for a specific international project. That means suppose a MNC want to start an investment in UK and it require funds in pound, so it may issue pound denominated bonds. Next, third, to cut the cost of financing, MNC also go for international bond investment. We know that international bond has a cost of finance. To reduce the cost of finance, we can go for international bond investments. So the foreign bond market is of three types. The foreign bond market can be classified into three types. One is or international bonds can be classified into three parts. International bonds is of three parts. First one is known as foreign bond. Second one is known as euro bond. Third one is known as global bond. So we will discuss what is the difference between foreign bond, euro bond, and global bond individually. Okay, so what is foreign bond, what is euro bond, and what is global bond? And all these classification depends upon two factors. First factor, the currency in which bond is denominated and the market in which it is issued. Two factors. One is currency denomination and issuing market. Let's take an example. Suppose the issue market is USA. Issue market is USA. In USA, and international bond is issued. And if the bond is issued in USA, what is the currency of USA? Currency of USA is dollar. So if in US market a dollar denominated bond is issued, that is known as foreign bond. If the bond is denominated issued in US market and it is denominated in any currency other than dollar, that means non-dollar denominated bond. Non-dollar means it may be yen, it may be pound denominated bond. That is known as euro bond. So what is the major point of difference between foreign bond and euro bond? Foreign bonds are denominated in a currency in a currency which is equal to the currency of the market where it is issued, and euro bonds are issued in a market and denominated in a currency other than the currency of the market where it is issued. Let's take an example. In India or in UK a bond is issued. So issue market is UK. Issue market is UK. If issue market is UK, so what is the currency of UK? Currency of UK is, let's take an example, pound, Great Britain pound, GBP, denominated bond will be treated as foreign bond. And a non-GBP, suppose a dollar bond, dollar denominated bond is issued in UK market, that is known as euro bond. Am I clear? What is euro bond and what is foreign bond? Foreign bond and euro bond. Foreign bonds are denominated in a currency and issued in a currency where the denomination currency and issue currency, market issue currency are equal, that is known as foreign bond. And where denomination currency and market issue currency are different, that is known as euro bond. Am I clear? Euro bond and foreign bonds. Okay. So a foreign bond is an international bond issued by a borrower who is not a resident of the country and bond is being placed. This is foreign bond. Now euro bonds. What is euro bonds? Euro bonds are those that are sold in a nation other than one whose currency the bond are denominated in. I have discussed what is Eurobond. Okay, what are the features of Eurobonds? First, following are important features of Eurobond. First feature of Eurobond is there is no ownership record, and these bonds are issued in bearer form. What is bearer form? Anyone who own it, he becomes the owner. There is no registration, ownership record of the bond. So these bonds can be transferred merely by delivery, just like currency note. Second, payment on coupons are made yearly. Coupons mean interest. Interest payments are normally made yearly. And normally these bonds have a convertibility clause. That means they can be converted into equity shares. Then there is lack of protective covenants, means restrictions in these bonds. Okay, and sometimes a call provision is attached with Eurobonds. And in case of Eurobonds, if the interest rate is not fixed or variable, that is known as floating rate notes. Normally, FRNs are Eurobonds having variable rate of coupon or interest. Normally, there exists a secondary market for Eurobonds. What is secondary market for Eurobonds? What is a primary market? Primary market is a market where bonds are issued for the first time. And if the existing bonds are purchased and sold, then it is done in a market that is known as secondary market. So if there exists a active secondary market, normally there exists a active secondary market for euro bonds, but for foreign bonds, secondary market may or may not exist. That is the difference between foreign bond and euro bonds. Next, bond is global bond. What is global bond? So we have discussed foreign bond and euro bonds. Foreign bonds are denominated in a currency which is equal to currency of the market where it is issued. Euro bonds are denominated in a currency which is different from the currency of the market where it is issued. Next, global bond. What is global bond? Global bonds are normally issued in 5, 6, 8 countries simultaneously. These bonds are simultaneously issued in different countries at a time. At a time, they are issued in 4, 5 countries, and this is known as global bonds. Normally, global bonds are denominated in a particular currency. We know that most of the global bonds are denominated in USD or US dollar. Majority are expressed in dollar. So global bonds are the bonds which are simultaneously issued in different market. So it is simultaneously sold on traded in important markets all over the world. That is known as global bonds. Next we will discuss what are the risks in case of international bonds. What are the risks? We will discuss what are the risks of international bond investment. We know that there are many types of risks associated with international bond investment. The first important risk which international bond investment suffer from is known as interest rate risk. What is interest rate risk? We know that the value of the bond is inversely related to interest rate. If interest rate in the market increases, the value of the bond decreases. There is a which relationship? Inverse relationship. So interest rate and value of the bond is inversely related. So if there is decrease in the value of the bond due to increase in the interest rate, it is known as interest rate risk or coupon risk. Okay, so with increase in interest rate, bond valuation constantly decrease. Normally, fixed rate coupon bonds are subject to interest rate risk. But in case of floating rate coupon bonds, interest rate risk is minimum in comparison to fixed rate coupon bonds. Okay, so fluctuation of interest rate will affect the bond price, and this is known as interest rate risk or coupon risk. Second important risk, which is existence in case of international portfolio investment or international bond investment, that is exchange rate risk. We know that all the international bonds are subject to exchange rate risk or currency risk. Currency risk means if there is currency appreciation, if the bond's currency appreciates in value relative to investors home currency, then the value of the investment goes down, and it is known as exchange rate risk. Suppose a US citizen invest in India, and a US citizen in USA, he invest in India. Okay, so in USA, their currency is USD, US dollar, and in India, currency is rupee. Where he invest? He invest in India. So if Indian rupee value appreciates, Indian rupee value appreciates, then the dollar bond value depreciates. So the foreign investments are subject to which risk? Currency risk. Next risk is liquidity risk. Liquidity means convertibility into cash. The liquidity risk of a bond depends upon a active secondary market. If there is active secondary market for a bond, the liquidity risk is less. If there is no such active secondary market for the bond, there is huge amount of liquidity risk associated with the bond. Next risk is credit risk. What is credit risk? Credit risk is also known as default risk. All the international investments, bond investments, carry some sort of credit risk or default risk. What is the credit risk or default risk? That is also known as counterparty risk. That means the other party may not make payment in due time. That is known as counterparty risk. The counterparty risk may be temporary or it may be permanent. There may be temporary or permanent suspension of interest or principal repayment to the investor, and this is known as credit risk associated with a international investment. So international investments are subject to following four type of risk. What are the four type of risk? First risk is interest rate risk, exchange rate risk, liquidity risk, credit risk. Next, we will discuss regarding international equity market. Nowadays, countries are not only raising equity capital from its own country. Companies are raising equity capital not only from its own domestic country but also from international markets. They are raising equity ownership funds from different countries, from different market. That creates international equity market. So there is global integration of equity market, and the global integration of equity market started due to the following reasons. First, investors now know the advantage of global portfolio diversification. They know that in order to reduce country specific systematic risk, the only strategy is international investment, international portfolio investment. Second, the abolition of fixed trading commission and a reduction of government restriction on investments or foreign investment has increased international equity culture. Third one is information distribution, clearance, settlement, modern computers, communication technology developments is the third major risk or third major reason for international equity investment. The fourth reason for international equity investment is that is MNC get the benefit of cross listing. Cross listing matlab cross listing means listing the securities in different stock markets at a time. In home country they list the securities, in host country they also list the securities. That is known as cross listing. Listing of share in different markets at a time. That is known as cross listing. Now we will discuss how international equity investments will be done. The international equity investments are done with a concept known as depository receipt. What is depository receipt? Let me tell you. International equity investments are done with a concept known as depository receipt. Let's take an example. Infosys is an Indian company. And it wants to raise shares in Indian, suppose in USA market. So Infosys wants to issue shares in USA market. It can done with the help of depository receipt. Suppose it wants to float shares in USA market. So what Infosys will do? Infosys will select a US bank, US based financial institution. This bank is Bank of America. Infosys will give the share to US bank, and US bank will convert the share. Infosys will give the share to US bank, and US bank will convert the share into depository receipts. As these depository receipts are issued in USA, those are known as American Depository Receipts or ADRs. Now please see, Infosys issue Indian shares to a US based financial institution, Bank of America. Bank of America convert these shares into depository receipts, and these depository receipts are issued in USA market. Therefore, those are known as American depository receipts. So if a non-American company wants to raise equity capital in US market, they have to go for ADRs or American depository receipt routes. Similarly, if one Indian company is Infosys, it wants to raise money from UK market. UK market, so it will first select a UK based financial institution, suppose Bank of England. So it will issue shares to Bank of England, and Bank of England will convert these shares into depository receipts and issue in UK market. As it is not USA, any depository receipt issued outside USA are known as global depository receipt or GDR. That means the depository receipts traded in US markets are known as ADR, and depository receipts traded outside US, any market, that is known as GDR. Okay, so if an Indian company wants to raise shares or issue shares in US market, it will go for ADR route, and if it wants to raise shares in any market other than US market, it will go for GDRs or global depository receipts. ADRs or GDRs are depository receipts. In this case, the financial institution is the custodian bank. Financial institutions are known as custodian bank, and they are the registered owner of the securities. They are the nominal owner of the security. The financial institution. What is the financial institution? In case of ADR, we have discussed Bank of America. It will be the nominal owner. Securities will be in its name, but ADRs will be in the name of the American investors. And the American investors here are the beneficial owners. All benefit will get by American investors, but the shares will be in the name of Bank of America. He is the registered owner or nominal owner, and American investors are the beneficial owner. Similarly, or in case of GDRs, the nominal owner is Bank of England, and UK investors are the beneficial owners. So there are two types of ownership. One is nominal ownership, another is beneficial ownership. In case of ADRs and GDRs, the nominal ownerships lie with the financial institution which issued these depository receipts, and the person who buy these depository receipts are the actual owner or the beneficial owners. Only for namesake, the shares are in the name of the financial institution, but all the benefits are invested are get by the American investors or foreign investors. So this is a concept of ADR and GDR. ADR and GDR both are depository receipts, and these are issued by financial institutions, and with the help of this, the overall investor make investment in foreign companies through their own domestic exchanges. Okay, in this case, there is a depository bank or custodian bank. The custodian bank is the registered owner of the securities, and he acts as an intermediary. He manages the share issuance, administration, share listing, and other aspects of the shares. This is the difference between ADR and GDR. All depository receipts except ADR are known as GDR. So what is GDR? All depository receipts except ADR are GDR. Example: Japanese depository receipt is a example of GDR. Indian depository receipt is a example of GDR. Am I clear? So ADRs are traded in USA market and GDRs are traded in any financial market other than USA, that is known as global depository schemes. So we are discussed the concept of ADRs and GDRs. Next we will discuss international equity market benchmark. Throughout the world there are certain benchmarks or index to track international securities. These index are many. Many indexes are MSCI index. There are many Europe indexes. There are Pacific index which track international investment, emerging market index, EAFE index, MSCI index. Okay, then global stock market index, ACW index. These are some of the example of international equity index. A index track a particular market. Okay. Next, measuring exchange rate risk on foreign securities. Now we will discuss how to measure a risk in a foreign security. In a foreign portfolio, how risk is measured. We know that foreign investments are subject to currency risk. Hence, the foreign portfolio investments are subject to currency risk, and you can find out the real value of return with the help of following formula. RI dollar is equal to 1 plus RI plus 1 plus EI minus 1. So what is this? What is RI dollar? It is the rate of return in dollar term or in foreign term, foreign currency term. What is RI? RI is equal to local currency rate of return. What is EI? EI is the exchange rate between local currency and foreign currency, home currency. We know that exchange rate may be appreciate or depreciate. If exchange rate appreciates, the EI will be positive. If exchange rate depreciates, the EI will be negative. EI expected to be positive if foreign currency appreciates and negative if foreign currency depreciates. Let's take an example. Suppose an Indian firm invests in a US ABC Limited and the share price increased by 15%. The share price increased by 15%. That means there is a 15% rise in your investment. But the dollar value depreciate by 5%. So two things arises. Your foreign investment increased by 15%, but the dollar value depreciate by 5%. What is the return you get in dollar term? You know that in this case, the domestic return is 15%, 0.15. RI is 0.15 and EI is 5%, and dollar value depreciates, foreign currency depreciates, therefore it is in minus 0.05. And if you put the formula which we have read, that is R in dollar return is equal to 1 plus domestic return into 1 plus exchange rate minus 1, we can put it and find out dollar denominated rate, that is equal to RI dollar is equal to 1 plus 1.15 whole into 1 plus minus 0.05 minus 1, and it is coming to 0.925 or 9.25. Though your share price increase in rupee term 15%, rupee return is equal to 15%, but a dollar based return will be 9.25%. Dollar based return will be 9.25%. Because the foreign investments are subject to exchange rate risk or currency risk. In case of foreign portfolio, the formula to find out a risk is this. What is the formula? Variance I dollar is equal to variance RI plus variance EI plus 2 covariance RI into EI plus change in variance, where change in variance is the contribution of cross product term and RIEI is equal to risk of foreign investments. So we know that in case of international investments, there are three parameters to measure the risk. These three parameters are very important to measure the risk in case of an international investment. First, the volatility in home currency, that is variance EI. Next one is covariance with local market return, covariance RI EI, and the contribution of cross product term, that is called to change in variance. These are the three factors which determine the risk in case of international portfolio investment. Next, international portfolio diversification. We know that normally people diversify their portfolio to reduce the risk. Now, international investors holding foreign stock, bonds, and other financial securities are interested in international diversification. And this international diversification is possible when you invest in different markets which are not correlated to each other. That means, suppose you are holding Indian market stocks and you are facing a systematic risk with Indian market stocks. You want to reduce this country specific systematic risk. You want this to reduce this with a foreign investment. With which country shares investment you will diversify so that you will get the benefit of reduction of risk of Indian portfolio stocks. In this case, you have to find out correlation, and the country with which your correlation, your stock market return and that country's stock market return, and you find out the correlation, and the country where the correlation is less, you should invest in that type of country. Okay, let's take an example, Australian market. Suppose you have a Australian stock exchange and these are different countries with which correlation is given, and you see that the correlation of Australian stock market return is less with Japanese market return. So Japan is an ideal market for getting investment for Australian investors. So you have to find out like this, with which country stock market return, your country's stock market return has a low level of correlation. Okay, so you can calculate pair-wise correlation of stock between different countries, and the country where the correlation is less, where it is less correlated, that give you an ideal situation for international diversification of your portfolio. Okay. Next, we will discuss a concept called home bias. What is home bias? We know that international investment reduces risk. It reduces country-specific currency risk. So everybody must invest internationally to reduce their systematic risk. But practically, we see that there is a deviation of this rule. People are more interested in investing in their domestic market than the foreign market. Though foreign market investment reduces their risk, but people have a clear bias of holding home country portfolio than foreign country portfolio. So in order to get optimal portfolio, one must invest in different countries, but practically investors are interested much more in investing in their own country than foreign country. That is known as home bias. And this concept is known as home bias. Okay, most investors show strong home bias in their portfolio holding. What is home bias? Portfolio holding in the home country, which has been documented by various authors, is known as home bias. So, what are the reasons why home bias arises? There are different reasons why home bias arises. The home bias arises because investors invest heavily in domestic equities has a home bias because of inclination of investors to allocate their money in domestic bond rather than equities as a hedge against inflation. Most investors try to hedge against inflation, hedged against domestic inflation. And most investors are risk averse in nature. Risk averse means they do not want to take risk. They take risk only to cover off their domestic inflation. As long as domestic investments cover their domestic inflation, they are happy with it. Since they do not want to reduce their country specific risk by taking another risk that is known as exchange rate risk. We know that the foreign investments are subject to exchange rate risk. Most of our domestic investors invest in equities to hedge against inflation, and they are risk averse in nature. Do not want to take much more risk. They only take a risk of equity investment due to cover the domestic inflation. Therefore, as long as domestic investment covers domestic inflation, they are happy with domestic investments. They do not want to take higher degree of risk and volatility by going for foreign investment. This is known as home bias. First reason for home bias is this. Next, the second reason of home bias. The second reason of home bias arises due to restrictions imposed by different countries on their portfolio investments. Normally, in home country, the government put restriction on foreign investment in order to avoid foreign drain of capital. Every country's government want that their country's money should be invested in their country, not in foreign country. And they put some restrictions on drain of capital from their own country to foreign country. And due to these restrictions, people has a bias towards investment in home country and then foreign country, that is known as home bias. Next one is target or host country restriction. We know that host countries sometimes put some restriction on foreign investments. Normally, if the economic condition of host country is not perfect, it puts some restriction on percentage of foreign investment so that their country's companies cannot be taken away by the foreign investors. They want to avoid foreign acquisition and foreign hostile takeovers. To avoid foreign acquisition and foreign hostile takeovers, they put certain restrictions. These restrictions are predominant after COVID-19 crisis. After COVID-19 crisis, there is huge crash of stock markets throughout the world. So at that country, at that time, many governments put restriction on foreign portfolio investment to avoid hostile takeover, to avoid foreign acquisitions. And third and major reason for home bias is investing in foreign securities is complex due to tax structure and additional transaction cost. We know that foreign investments are subject to foreign tax, and foreign investments, the transaction costs are high. Therefore, people prefer to invest in their domestic market than the foreign market. And this is also known as familiarity bias. So these are the reasons why people are interested in domestic market investment than foreign market investments. This is known as home bias. Now let me first summarize my discussion today. What we have discussed? We have discussed advantages and disadvantages of international diversification. We know that international portfolio investments are done to reduce country specific systematic risk. All investments do not reduce country specific systematic risk. One must invest in that country where stock market return of your country and stock market return of that country are less correlated. Okay, so international investments give some sort of risk hedging against country specific political risk. But though you invest in international markets, if there is global risk, global economic conditions, global risk, it cannot be reduced. So if there is global financial crisis, if there is global interest rate crisis, if there is global war, then in that case, international investment cannot reduce the risk. Hence, before diversification, you have to know the merits and demerits of international portfolio investments. So these are some of the self-assessment questions on our discussion today. First, give 5 reasons why an investor should consider investing in international securities. In this case, you have to write down the benefits of international portfolio investment. What are the type of risks that our investors is more exposed to while holding a portfolio comprised to international securities? We know that the most important risk is exchange rate risk, control risk. What is the difference between foreign bond, euro bond and global bond? We have discussed foreign bonds and euro bonds. This depends upon the market in which it is issued and the currency in which it is issued. Foreign bonds are issued in a market and in a currency. Both in case of foreign bonds, both the currency of the issuing market and the denomination of the bond are same. But in case of euro bonds, the currency of the issuing market and denomination of the bond are different. And global bonds are the bonds which are issued simultaneously in 2-3 markets. Then we have discussed GDR, explained GDR and how it is different from ADR. ADR and GDRs are depository receipts. ADRs are issued in US market, where GDRs are issued in non-US market. Any depository receipts issued in US market is known as American depository receipts, and any depository receipt issued in a non-US market like Japanese depository receipt, Indian depository receipt, UK depository receipts are known as GDR. Next, what is the role of intermediary or depository bank in issues of foreign equity? We know that the depository bank is to play the role of custodian bank. He is the registered investor, registered owner of the security. But the beneficial owners are the real investors. You have to write down regarding that. Next, which countries' rules, regulations do firm adhere to while making an international offering of equity? We have discussed international offering of equity are subject to two countries rules and regulation. Then we have discussed home bias. What are the reasons of home bias? People prefer domestic investment than foreign investment. That is known as home bias. We have discussed the concept of home bias and what are the reasons of this. And these are the further readings on this particular chapter of international portfolio management. With this, we come to conclusion of our discussion today. Thank you all for attending my session. Thank you all.